Howard Marks is a well-known value investor who defines risk as the possibility of losing the initial investment as well as fluctuation. He contends that larger anticipated returns should be offered by riskier investments with broader probability distributions. One must be aware that there is a catastrophic danger related to market bubbles. Therefore, the focus must be placed on how important it is to take the probability and distinguish between chance and result. Cycles must be understood.
People nowadays say to me, well, this cycle, which cycle from the past is it like? And it has some characteristics of others, but it's never quite the same.
He highlights the cyclical nature, citing the 2000 tech bubble burst leading to a 3-year stock market decline, sparking a decade-long wane in stock interest. Despite Fed rate cuts, bonds held little appeal, steering investors towards alternatives like hedge funds. Initially successful, hedge funds' effectiveness waned as they ballooned to $2 billion, fading from the mid-2000s spotlight. Marks emphasizes seizing discounted opportunities and purchase pricing for optimal returns. To put it briefly, he calls for seizing opportunities that are discounted during market cycles and underlines the power of purchase pricing in finding out the ultimate investment returns. This viewpoint emphasizes how important it is to weigh both the purchase price of assets and the intrinsic business value when making investment decisions. It is a simple yet very effective step if implemented successfully. Now you can also begin your financial journey by clicking the link in the description to open a free account to access stocks that are worth $2,000. Hit thumbs up to this video and remember to subscribe to our channel for more updates.